Yes, people. So this is going to be the first market breakdown I've done in a long while because this is the first week I've actually been trading discretionarily in a long while. So it's been an absolutely beautiful week in the markets, and it's been beautiful for the past 2 months, for months now, really. Um, and so I'm still trading the mechanical model, still trading that and executing that, but I also have allocated accounts for discretionary trading, and partly because for two different reasons. One, because these markets are so good in terms of the volatility that I want to be capitalizing or have at least somewhere where I can capitalize on these large range moves. And the second one is I just genuinely miss discretionary trading so much. Like, I love trading, I love markets, I love being involved in markets. I love the challenge of it, I love the stimulation of it. And the mechanical model, it although it alleviates so much stress, although the results are extremely effective, it doesn't scratch that itch for me. I don't get as much fulfillment out of it, which is also why it's so good. Like, the reason that is the attraction to the mechanical model. It is something that you do not have to stress about. You don't have to think about. You just literally execute when the setup presents, which is why, in my view, running them in tandem is the ideal situation because you can have the no stress, repeatable process, just cranking out consistently, and then also have the more stimulating, more difficult, let's say, not that we're trying to do stuff that's difficult, but challenging. I love a challenge, and I don't want to create that. Like, I want easy money. No, it's I just love it so much. So let's jump into the charts now. It's been an amazing, amazing week. So starting off with gold. So basically, I'm just going to do. I haven't done my weekly recap yet. I'm just going to do my weekly recap with you guys. And it's been a while since I've done a weekly recap, so it'll be fun. So gold, I had. Let's just move these together. Starting off with gold, because it's the first one open here. So this is my little dashboard inside the data section. Ooh. Second. So I had outlined here that gold is setting up for a pop. So we've had a double inside bar. So the talks with Iran are extending. This could pop at any time. I'll be watching both sides. So we have a first inside bar followed by a second inside bar. So an inside bar being where the high and low of the current day stay inside the high and low of the previous day. So anytime we see an inside bar, what we can do is anticipate the following day to be a large ranging day or an explosive day. When we get an inside bar followed by another inside bar, this is adding to that probability that we're going to get a large expansion. So we had two inside bars here, so I was like, okay, cool, today's going to be an explosive day. Mark that up, added it in here, waiting for a trade. So I then posted this on Twitter saying I'm looking for a break either side and to hit that trade. I said I would prefer the long side just because of the higher time frame bias on gold. It's just bullish, but I would take it if either one set up. So we ended up actually breaking out on gold and took some positions in here and then took some positions as we pulled back on 130. So I initially set my limits. I had set limit orders here, anticipating us to pull back and get tagged in. We didn't pull back, so as we dumped on the news pull back here, I took some positions, leaving my limits on in case we did pull back that area, but we never did. So you can see as we pulled back in here, and I had my further buy limits to scale up my position size, but they never got touched. So I held into the close. It's now the weekend, so now we are on the close. So I am 4.5% up, just under 4.5% up on this E8 account. My first account with the E8. So far so good. It's a one-step challenge. My first ever one. I guess futures are one step. My first experience with a one-step CFD account. So far so good. We've just taken EU positions and this gold position now here, and we'll go through the EU one as well. But yeah, that was gold. Still holding this. Still anticipating this for further upside. We got a lot of space here, guys. So this could be a runner. Also to note, it's the beginning of a new month, so that was the last trading day of the month. So now we're going to be opening a new monthly candle. So it's always, we got to pay attention to daily closes coming into monthly candles. Obviously we've closed in breakout, highest closing price of the month, closed outside of the range. So let's see what we do on Monday. It could be a very big gap in either direction, who knows. So yeah, that is gold. EU, so we had a lot of fun. So this is the mech model and this is discretionary. So mech shorts early on there. This is obviously 27-1 mechanical entry. Some mechanical losses here, mech win here. And I think this was the first discretionary trade I took. So we initially took our first entries here. Stop loss just kept us in, to be honest. So why did we enter in this position? That is very ugly on the daily. I don't want to see that. Let's just turn that off. Visibility on the hours, days, weeks, months. There we go. So we are very bearish on the dollar overall, which then makes us very bullish on the euro. Just because of everything that's going on, the dollar is just, Trump is not supporting the dollar. All of this talks with Iran, uncertainty, all of that stuff, it's just weakening the security and the safe havenness of the dollar. So overall, just fundamentally, we're bullish on euro, bearish on the dollar. So when we have that bias, let's say, then we're just looking for, okay, we can't just go long and hold. I don't have the account size to be able to do that, to be able to eat a big loss, let's say, or just to hedge it and just swing it. But I do want to be entering in positions where I can, or entering at times where I can position myself to catch a move. So when does that happen? When we tank down. So obviously, when the euro gives us large downward movements, lots of volume into the market on the short side, that is the opportunities, like buy when there's blood in the streets. That gives us the opportunity, excuse me, to take a long position. So when we had this daily candle closure like this, large candle closing in breakout, this is one of my favorite things to see in terms of if I want to take a long position, I want price to first close in breakout at or near the extreme. That means that lots of volume is getting into the market short, which can then be trapped. Whoopsie daisies. So we are looking to take longs. Sorry, I was trying to figure out what's going on here, and did I enter in mechanically? Because I remember thinking I didn't enter in on the mechanical model, but our bias was bearish on the mechanical model, but I was looking for longs, but I was still seeing if I could get a no bias entry. We didn't end up coming back to the entry zone. So as we pulled up here, we had a sweep, and then we broke structure here. So we inverted this whole area here, and this was really what led me to want to take this position. The day opens, and then London just dumps, and then we dump further. So just imagine what's happening with all the liquidity. So we had a day which closes in breakout. Remember that large ranging day? We've closed at or near the extreme. In this case, at the extreme. And then, so here it is. We close here. This is a huge, large ranging day, big bearish day, and we pump and we dump down again. So all of the volume in the market currently is short. Everyone who's in the money is short. New York opens, we dump again, and then we dump again. And if we have a look, we dumped into the low. So London's dumped, we create a new range, and then we dump again. And then these large volume candles, the same way that the daily closure extremely bearish near the extreme, it actually can be a bullish signal in the right context. Same with this, these candles breaking out of this range, closing extremely bearish, gapping down, can be a bearish signal or can be a bullish signal with the right context. So the fact that we have a lot of money, a lot of volume in the market short, we are overall higher time frame fundamentally bullish on this pair, and then we excuse me, we're dumping down all day, everyone is in the money, is short, then we dump down here and then invert that with large volume to the upside, inverting all of this, swallowing up all of this. I then added my first positions. So annoyingly, I took these on futures accounts, and they obviously get closed on the daily switchover. So I didn't actually end up being able to hold this position, but entered in the next day and the following day. So we pulled back here, trying to think where I entered in this day. Okay, here, so then we are in New York. My bias is still extremely bullish, and then we sweep. So we take out the previous low, break structure, and then pull back. So this actually could have been a mechanical entry. I do not remember, but it's the same entry criteria. You know what I mean? And again, the mechanical model is the same kind of things that we want to be looking at for no matter what. Like whether we're using a discretionary model, discretionary model or a mechanical model, we want to wait for buyers to get taken out if we're looking to buy, early buyers. We want to wait for a confirmation sometimes. Here we have this confirmation, and then we entered in on the pullback here. And we actually went on a round trip here, so I was up a good bit of percent here, about 3% I believe it was, because I entered in on 0.8%. And then we came the whole way back down. So once, this was a bottom tick, to be honest. Again, not promoting this kind of stuff, but if we just think about it logically, nothing has changed. And we're still fundamentally bullish. The volume has now been trapped down here. So we sucked in loads of sellers and then pulled away. We don't need to return to this area down here. This area down here, anyone who's been trading in this area is underwater. Anyone who's been selling, more so, people have been selling, they're now underwater. So we can actually put that in, let's say, blue. These guys are all underwater. We do not have to revisit that area. So in the following day, when price pulls back, and look, observe the behavior. So it's creeping trend, creeping, and then fast volume. Fast volume where? To where? To where the current stop losses are. So anybody who bought on this day, and think about it, I was one of those people. Where did everyone buy yesterday? Well, they bought either in here, like me, or they bought anywhere along here. Anyone who's buying in here, where are they putting their stop? Here, at the low. So London, Asia pumps up. Asia pumps up. So all of Asia's, anyone who's traded in Asia, their stop loss is here. So as London opens and we trickling, coiled volume down and then volume candle into the low. Notice how this is the third time this has come up. Volume into the low. That is, out of all of the testing I've done, look, tracking all different metrics, we can show you some of them. Volume into the low is one of the most important things that we want to see. So you can see here, just showing you these different confluences which I've tested. But we want to see volume into the extreme. It's got a very high likelihood that that is going to be a winning trade when paired with other confluences. So this was paired with time and price. Price being we've taken out the stop loss. Time being we calm down into the low. So London opens first hour down. So this is the beginning of the second hour. Second hour down. And then on the half hour mark, we go 1, 2, 3. So we have the power of 3 into the low, just at the candle switchover, just at a 30-minute switchover. We take the stops and boom. So once we had this initial sweep that on the 30-minute switchover, I entered and actually managed to bottom ticket. This could have gone lower, but I had a very tight stop loss, which allowed me to capitalize massively on this move. Again, I didn't enter in a full 1%, but I didn't have to. Well, again, sorry. Let me show you the trade. Where are we going? Here we go. No, this was a one after. So the initial entries. Here we go. Entered. So these were the initial entries, and then here is the one. So as we came down, took the low here, boom, 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 bought here, scaled in as we had the initial reaction, and I scaled out of 2 positions here after. So we'd taken these stops here. So the price could have pulled back at this point. Think about it. We're always hunting liquidity. So we hunted the stop losses here. That's why we entered, and we TP'd here because we've taken these stops here. So I did hold a position for the next day just in case we wanted to push higher, but took profit here on these entries here. Excuse me. So then the next day, this was very nice trading, very nice trading. I was very happy with this. Next day, not so good trading. So this line here, this is where I eventually closed out of the second position that I scaled in here. So we took profit here, which is a beautiful exit, and then held on the whole way, added in here. Horrible, just bad trading, really. Like, even if we are fundamentally bullish, we still have to enter in at optimal areas. This was the opposite of entering in an optimal area. What I mean by an optimal area is here, if we notice, we're buying as price is dumping down. Here, we're buying as price is dumping down. Here, exact same thing. We're always buying as price is falling. That's when we're doing our buying. Here, I did the exact opposite. I was chasing price. So look at this, very easy visual to observe. We never want to be buying in a peak formation high. If we are buying, we want to be buying in a peak formation low. If we're selling, we want to be selling in a peak formation high. Here is our peak formation high. And in this instance, here is our most recent peak formation low. So I'm buying up into this peak formation high. This is where price would reject from if it wants to reject. This is where price would reject from if it wants to reject on the downside, excuse me. And obviously the range extreme is here. So I shouldn't be entering in positions up high like this. It was probably just cockiness from bottom ticking the day before. Just bad trading. Bad trading. It was only small positions, but it doesn't matter. Like, it's just, that's not optimal. So yeah, so held on. These ones hit stop loss, and then I closed out of this buy from which was in profit from here down here. So that was the trading this week on EU. Beautiful start to the week, and then Thursday, not a good entry. So yeah, that's EU. Lots learned there. Really good stuff. Oil, beautiful. So we look at oil. So oil, we're up high, volume contained above the weekly open. If we break below this, shorting opportunity. If we set up long, we're in the discount area, we could go to either side of the range here. So we can see here, pump, sideways, dump. This is textbook, volume contained in a box, up high. So we have liquidity injection, so that means everyone's going to be buying, and they keep propping price up, pumping. Peak formation high. What we want to see in these instances is a lower low. So we want to see price put in a low and then retest that area, whether it's the bottom of this rectangle here or even better, the weekly open. Think of the weekly open as just dynamic support and resistance, and a very good one at that. And it's actually moved in Asia, and I didn't take it, and partly because I'm monitoring too many pairs to be trading discretionarily. So with the mechanical model, 5 pairs is easy, super easy, because there's not much bandwidth that's required. You're waiting for only 1 or 2 pairs will be setting up at any given time, maybe once or twice a month, or 4 pairs set up at once. But for the majority of the time, you know what you're watching, and you're just watching one chart at a time, 1 to 2 max. In discretionary models, you have to be monitoring pretty much most of your charts most of the time. So this, I just marked it out, just doing up a playbook entry, but this was textbook, but I missed it. So I'm monitoring too many pairs, so let's just get rid of this. So I actually had an entry here, waiting to see if we got tagged in. We didn't get tagged, would have been a beauty. But look, so we have the volume up high, so we have our pump, sideways, dump, and look where we pump back up into. Better in the 15-minute, we can see. So there we go. So we have our pump, sideways behavior, volume contained in a rectangle above the high of the week. So we're in this rectangle here. What we want to see, a lower low put in place. So we have a lower low, and we want to see that area retested. So we're boom, just retesting that weekly open. That is dynamic support resistance. Then what we want to see, coiled volume. We get our coiled volume here. Better look at that in the 5-minute. And this is a fractal version of that. We have our pump, sideways, dump, and another fractal pump, sideways, dump. So we have our coil volume getting people to buy, lower low put in place. We could dump from here. We could just come up and tag this. We could come up here. You never know. But everything still stands the same. We have rejected and retested the weekly open, put in a lower low, coiled volume. This market is really only going one direction at this point. And yeah, just a beautiful move. If you miss this entry here, you have a pullback, and as that gets confirmed again, boom, you can short. Again, this was in Asia, I believe. Or was it? I remember this. Being late at night. Yeah. Middle of the night, 4 a.m. Well, this was London the next day. So if you missed this entry here, you can enter on this candle close here, stops at the high, and then just target. Let's have a look where we want to be targeting. These areas here where you can have potential failures, liquidity here, but I would like to target some kind of inefficiency in here. Can't really see anything, just anywhere in this region here. Double zeros in and around that level, or just targeting a fixed 1 to 2. This would have gone for a 1 to 3, but again, you're not going to carve out every single pip, but just taking some money in those areas where we can potentially fail. So taking some off here. You want to be, this market could have continued to the downside, you know what I mean? So very easy to say, oh yeah, just take profit here. This market could, it was set up that it could very well have come the whole way down there. And I actually was thinking that this price was going to come the whole way down to this area here. So take profit levels. It's up to you, but have it in a way that makes sense. That you're not just that you can capitalize on it. That you study price after it has moved, and yeah, and just dissect these opportunities. How could you capitalize the most out of this given move? So oil has now put in a big formation low and looking like it's trading higher. So I'm actually going to remove oil from my pairs now because I'm just watching too much stuff. Goodbye. I'll keep it for the mechanical model. How long have we been going? Half an hour almost. Nasdaq, we had some beautiful Nasdaq longs here, but the main Nasdaq move was, so I mistraded this move completely, and I'll show you how. So this move here, this is one of the best moves you can find in trading in the markets. Let's look at it on this chart here because it's easier to see. So these are days. On this chart here, these are sessions, all these vertical lines. These vertical lines here are days. You can see Monday to Tuesday. This is Tuesday, this is Wednesday, this is Thursday, this is Friday. A Wednesday closing in breakout at or near the extreme as the highest closing price of the week or month is it is the golden ticket of trading. And Stacey Burke, I learned this from Stacey Burke. And if we get that, like, you would lick your lips because this has the potential to have an ACB, so a trade that ain't coming back. Here we have this perfectly. We have level 1, level 2, level 3. Peak formation put in, close and break out at or near the extreme, and then we stay contained in that rectangle. This is going to be a repeat phenomenon if you watch my videos. Price volume contained up high or down low in a container or in a box. This will likely be, if I had numbers on this chart, we could see double zeros and 50s. Price would be contained within this area. We don't need to have those on. We can just see this visually. Price is contained inside this box. And then we have the same fractal behavior, pump, coil, dump. So pump, coil, dump on the week and pump, coil, dump on the day. I was not aware of that. I hadn't logged this. I had a lot of stuff on this week. I wasn't necessarily prioritizing the charts, doing my morning analysis, all that kind of stuff, which is now what I will be giving more emphasis to this because I'm now trading discretionarily. I have to do this. This is a requirement. And just missed a golden opportunity. And not only missed it, actually lost money counter trading a move that you should never counter trade. I was just looking at the 5-minute chart, just looking at, okay, what's happened? We've opened up here, dumped down, taken a lot of liquidity, just a very generic scalp, looking for longs, just for a continuation. When in reality, there was look at this. You can just scale into these positions and go break even as price is moving down, allowing you to compound and eventually have, let's say, upwards of 5% of risk on the table, but only risking 1%, let's say, so 5 times the position size. And that's how you can make up to 25% in a given move on opportunities like this. They don't come around all the time, but when they do, they are golden opportunities. So this, I'm going to dissect this further. I'm going to turn it inside out and just observe how could we have traded this better. So the signal, so there's 2 things to note down. This is a long video now, so I'll probably wrap it up on this. But we have signal days and then signals on the day. So the signal day was this day here. It was Wednesday. Wednesday closing at or near the extreme. So closing in breakout is the highest closing price of the week or month. So we close in breakout here and the volume is contained high. So it's better if we also have previous buying as well. So we have close in breakout 1, close in breakout 2. This could have gone up again and close in breakout 3, but it didn't do that. It didn't set up like that. So we never know what's going to happen, but we can just trade what we see. So we close in breakout again. So that's 2 closes in breakouts, and that just tells us there's lots of money in the market long. Lots of people are buying. There's lots of money. Where are people's stop losses? They're here initially, then they're here, then they're here, and then the last of the stop losses are down here. Look at this though. This is very hard to get into. We have a big move up, big move down, big move up, but still there's stop losses here. So all along these lows is just money, 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 money. So once we've realized that we've closed and breakout twice, we're then looking for, so that's our signal day. Now we're looking for a signal on the day. So we're looking for pretty much the same thing. We want price to pump up, but stay inside this area. We don't want price to break down. We want price to stay pumped up so that we can then have the move. Ideally, before New York. Like, we don't want London to start making lower lows because that's actually setting up for another move up. So what happens is we come and we just create a new range. We put in a low, put in a high, stay coiling, coiling, coiling. We have our pump, sideways, dump. So what time do we engulf? Just before equities opens, we swallow it up, and then we just keep tanking. So if we were prepared for this, anticipating this, you can wait for equities open if you want, have a little doji there, and then as you continue to break down, start scaling into this position, put in your first position, cover your risk as we move down, and then wait for any rejections. Here we have our first rejection candle. So once this gets engulfed and we start rolling over, that's when I would start adding to this position. And we want to be getting in as much, or the majority of our order, as we are rejecting this area here. So as we're rejecting the original range. So at as close as possible to this area here. Not doing what I was doing and buying, looking to trade back up into this. This is a different kind of market behavior than this trade, than I was looking to take here. The market was set up differently. The market should look more like this or like this to take this kind of trade that I was taking. Having the coil volume there, dumping down, wicking into it, faking out. It's different market conditions. It requires a different, we should be anticipating different behaviors. Yeah, so this is just absolutely golden opportunities that happen a couple of times a month on different assets. So, and this type of trade, the way I'd be managing it is trying to get in as much as I can up high, covering my risk once we break down, and I would just hold this into the close. This is just one of those ones where you just hold into close. So this is an all dayer. So then you'd be exiting down here. Beautiful asymmetric risk to reward. Yeah, wonderful opportunities. Look out for those closes and breakout at or near the extreme, especially on a Wednesday or a Thursday, as the highest closing price of the week or month. Cool. So guys, bit of advice or my input would be to, if you're going to trade discretionarily, you need to have your playbook. You need to have, first of all, you need to track your data, but you also need to have your playbook. So your list of trades that are A++, A, B, C, D, etc., and have those defined to a T. What do they look like? My brain is kind of tired now. Guys, I'm gonna wrap it up here. Just kind of motoring on now, but great to be back. It is, yeah, it's so exhilarating and thrilling to be back trading discretionarily. Thoroughly enjoying it, and really looking forward to and enjoying doing more videos like this where I can actually break down and dissect stuff more. So if you've stayed till the end of this video, 35 minutes in, shout out you. Lots of love, and yeah, there'll be a lot more coming. Nice one.